The Fed signals rate hikes are coming. How will this impact real estate and your finances? Let's get right into it. Okay, so I'm going to go ahead and share my screen here. We have the Consumer Price Index 2021 year in review, and these are the inflation numbers on all items, and it's broken down into each category. And this is why the Fed is actually looking at raising rates to begin with. They had several supply chain issues along with almost an endless amount of money printing and stimulus, and it has caused inflation to go through the roof. You can see here that all items on average have gone up 7%. That's a year-over-year number. But I want to bring your attention to some of the craziness that we've seen and some of the stuff that we pay for and we spend on an everyday basis. Take a look at gasoline. It is up almost 50% in 1 year. Used cars and trucks, 37.3%. Energy, 29.3%. That is the increase year over year. That's your utility bills right there, electricity. Look at gas service. It's up 24% in just 1 year. And then meat, poultry, fish, eggs, 12.5%. Even new vehicles are up almost 12%. I mean, I don't know about you, but these are the types of things I spend money on every single day and every single month. It would be things like food, energy, fuel for our vehicles, and things like that. So pretty unbelievable how much inflation has ran up, and the Fed is in a tough spot right now. They need to combat this inflation, and that is why the Fed is signaling that there will be 3 rate hikes here in 2022. So we know that the Fed wants to go ahead and raise interest rates to combat inflation, because inflation ultimately erodes the purchasing power of the dollar. And obviously we have seen that in just the everyday goods and services that we purchase on a regular basis. In addition to that, we have seen housing prices over the last 12 months go up roughly 18%. Now, many forecasters are stating that mortgage rates are going to be going up this year dramatically. So what I did is I was curious to see how the federal funds rate actually impacts the 30-year fixed rate mortgages. So up on the screen here, we have a chart. The red line is the indication of the federal funds rate, while the blue line is the 30-year fixed rate mortgage. It's the average in the United States. And it goes all the way back to 1955 for the Fed funds rate, but they started tracking these mortgages, it looks like, somewhere around 1971. And from what I can tell here, when they raise the federal funds rate, it is a leading indicator as to what those mortgage rates will do. So couple areas that I want to bring to your attention here. Let's first look at the period in time leading up to the great financial crisis in 2007 and 2008. So if you look on this chart here, you can see that the federal funds rate in 04 or 05 there was at or near about 1%. So it was very, very low, and that was coming off of a high that they had back in 2000 and 2001, right before the dot-com boom and bust. The federal funds rate dropped down to about 1%, and then they started raising those rates right around the end of 2004 into 2005. Now, if you look closely, the initial reaction of the mortgage rates were to actually go down. But then as the federal funds rate continued to increase, we saw the mortgage rates go up slightly. And you can see at this peak here, right around 2006, there's a very small divergence between the actual Fed funds rate and the 30-year fixed rate mortgages, which were averaging about 6.3% at that time. Now, many of you are aware, right in around 2007, when the mortgage meltdown or the great financial crisis took place, the Federal Reserve dropped those rates down to 0 in a very short period of time. This gray bar on the chart is the indication of that great financial crisis. They dropped the Fed funds rate down to the 0 bound in 2009, and they kept it there all the way up until about 2015 before they started hiking rates again. And then you can see right here that in 2015, it looks like the Federal Reserve, they started to raise the Fed funds rate again, and the initial reaction of the 30-year fixed rate mortgage was to actually go down. As the Fed funds rate increased, mortgage rates increased along with it, And then back in 2018, that was sometime around that taper tantrum, the Fed reversed course and they dropped the rates back down to near zero, dropping it all the way down to zero in 2020 when the pandemic hit. And that's when you can see that mortgage rates hit an all-time record low. So what's interesting here as you're looking at this chart is that we see the 30-year fixed rate mortgage is actually starting to go up a tad. And I think it's pricing in those rate increases. It's essentially front running those increases that we expect to see here in March and moving forward into 2022. The question that I have, what I'm interested in, is that if they do in fact raise those rates, will the 30-year fixed rate mortgage actually come down in the short term before heading back up again? Only time will tell there. But so here's the thing. With mortgage rates at all-time record lows, we've seen housing prices at all-time record highs. If we pop over to the median sales price of homes in the United States, you can see that we are coming off what looks like a peak in the third quarter of 2021, where the average sales price was $411,000. And in Q4 of 2021, it went down slightly to $408,000. However, on the supply side, we have a very low amount of inventory. We are sitting at an all-time record low at 910,000 units for the entire United States. That's as of December of 2021. Now let that sink in for just a second. I think the US population is somewhere around 329 million people, and there are less than 1 million units available for sale. I think that's just over 0.25%. So with all that said, what does this actually mean for real estate prices? Are they going to go up? Are they going to go down? Are we in a bubble? Is the market going to crash? I'm still trying to figure that out myself. But my initial thought, based on the data and the information that we just reviewed, I personally think that a crash or a market pullback in real estate prices is not really likely to happen in 2022. Even though interest rates are likely to increase, which decreases affordability, making it more expensive and harder to qualify for a mortgage and purchase a house, I think the supply or the inventory side of things is just far too low to warrant any major or significant reductions in price at this point. So unless there is some kind of catalyst or something that takes place that brings more inventory or supply on the line, I personally believe that real estate prices are likely going to stay stable, if not even appreciate a little bit. Now, the downside to this obviously is that the cost to borrow goes up. That means that it's going to become harder and harder for first-time home buyers to get involved in the market. Now, before we move on, if I could ask one small favor, if you are getting any value out of this video whatsoever, please consider smashing that like button. It really helps grow and promote the channel. Thank you. So now, how does the Fed raising rates actually impact your personal finances? So we know that it raises the cost to borrow, which impacts your mortgage, but aside from your mortgage, does it impact anything else? The answer to that is yes, it absolutely does. In particular, it impacts those things with variable interest rates, things like credit cards. So the cost of borrowing, if you carry consumer debt and you hold it on a credit card, that is likely to increase. Now, the other thing it impacts is things like car loans and student loans. And so in general, the cost of borrowing across the board will increase, which will take more and more money out of your pocket each and every single month if you have debt in those specific areas. But on a more positive note, it will also increase the savings deposit rates that you get at the bank. The national average today is only 0.06%. And to put that into context, that means that if you have $100 on deposit, you will get 6 cents on a monthly basis. So it is a very, very low amount of interest that you actually earn when you place that money on deposit with the banks. So on the plus side, those rates will likely increase, but they will probably lag the federal funds rate increases, number one, and number two, they're likely to be relatively small, especially when you compare it to inflation. So if inflation, even if it goes down from the 7% year over year figure that we're at today, maybe we see 5% or 3%, but you're only earning less than 1% in the bank, then you have essentially a negative carry on that money, meaning that your purchasing power is eroding by the delta of those two figures. So now if we know that the cost of borrowing is increasing and we're not going to earn much interest by putting our money in the bank, then the real question becomes, what can we actually do? So I made a list that I'm going to go ahead and run through and share with you here today. So number one, you can review all of your expenses and cut out or reduce any unnecessary spending. So this is really simple. All you have to do is log into your bank account, download your bank statements, and just go through line by line and take a look at what you're actually spending your money on. Trust me, you'd actually be really surprised on what shows up. I know I personally was, but things like subscriptions, things that you don't really use often, things that are unnecessary, you can go ahead and reduce or eliminate those entirely. The other thing you can consider is buying items in bulk. Things like non-perishables or stuff that you're going to use throughout the year that might be impacted from the continued rise of inflation. A good example of something like this would be things like shampoo, toothpaste, deodorants, Q-tips, things like that you can go buy in bulk at a store like Costco or Walmart. The other thing you can consider is reducing the consumption of the energy within your household. So if you have older incandescent bulbs or something like that, you can switch over to LEDs. You can practice turning off lights behind you. I know that is a pet peeve of mine. It sounds silly, but every little bit helps here. And I don't mean, go out and be super aggressive on all of this stuff, but just be cognizant and be aware and just be mindful of some of the things that you're spending money on and maybe some of the excess power that you're burning around the house. It'll help lower your energy bills and help reduce some of your costs over the year. Number two is that you can carry fixed rate debt. So if you have an adjustable rate mortgage, I would 100% consider a fixed rate. Fixed rate debt will do really well if inflation continues to run at a high pace, especially right now where mortgage rates are lower than the actual rate of inflation. Even with mortgage rates increasing here in the future, they are still historically very, very low. If you have a home equity line, that is generally a variable rate mortgage and it can increase as rates go up. I would consider calling up the mortgage servicer and seeing if they have a fixed rate option available for you. Item number three, if it is possible, I would pay off any credit cards or anything containing variable interest rates. Or if that is not possible, perhaps you can find a credit card company that is willing to do a balance transfer with a 0% interest rate for 12 to 18 months, something where you can lock in a really low interest rate and aggressively attack that and try to pay it down as quickly as possible. Item number four, I would establish an emergency fund if you haven't done so already, and I would try to fund that with 3 to 6 months reserves. That gives you a little bit of financial runway in case anything comes up. You can handle it. You have a little bit of cash in your savings account at the bank, and I would do that despite the negative carry that you have with inflation. So even if you have that money sitting in a savings account and it earns less than 1%, and we know inflation is higher, I would still consider having an emergency fund in cash in the bank so that if anything comes up, you can easily tap into those funds and address the issue. Number five, invest in assets that pay you to own them. An example of that would be rental real estate that cash flows from day one. It allows you to get 30-year fixed rate debt. You can secure it at a historically low interest rate, so you get the debt pay down, you get potential appreciation, and in addition to that, you get a new income stream that will likely increase as inflation increases. But if you're not interested in investing in rental real estate, or you're not ready to do it quite yet, then you may want to consider dividend-paying stocks. You can look to invest in funds that have a dividend yield, or you can look at really solid companies that have a dividend yield that is increasing and has been steady for several years. There's many of them out there, and the beauty with these is if you can purchase a stock in a company that maybe pays you a 3% dividend yield, that may not quite keep pace with inflation, but at least it's better than what you're getting in the bank. And then in addition to that, you have the ability to have that stock go up in value over time. Now, if you're worried about a market crash, you might consider starting really, really small. Set up a small account with a brokerage of your choosing. I really like the M1 Finance platform. It's very easy to set up. It's user-friendly. You can invest for free. And then I would just start with small increments, and I would dollar cost average while keeping some of the cash on the sidelines when you're waiting for those market opportunities to present themselves. Item number 6, maintain steady employment. So this seems super basic and simple, But I think overall it's really, really important. If we do get into a position where we head into a recession, then your income stream is going to be critical to help carry you through to the next step or next phase or next chapter in your life. So maintain that steady employment. Don't leave your current employer without actually having another one lined up already. And number 7, which is my personal favorite, invest in yourself. So this is one of those things that I think people are like, yeah, I've heard this before, but I really do think it's true. I think that this is where you're going to get the greatest return on investment. So a couple things you can do. You can increase your skills at work. You can get a mentor. You can take on more responsibilities. This will likely put you in a position to become more valuable to your employer, which will lead you to new opportunities, either with a promotion or higher pay. The other thing you can consider is getting a professional license in a field or trade that you are interested in. So if you're interested in real estate, you could get a real estate license. If you want to learn how to do mortgages, you can get a lending license. If you want to do flooring, you can get a flooring contractor's license, or you can become a general contractor. The point is that if you invest in yourself and improve your skills, then you can start a side hustle and create another flow of income for yourself. All right, so that is going to do it for today's video. Thank you so much for taking the time to watch. If you haven't done so already, please consider smashing that like button and tapping that subscribe button to see more weekly videos just like this. Thank you so much. Have a great day.